Hello everyone, and welcome back to Accounting and Auditing Hub. Have you ever wondered how a simple receipt for a cup of coffee eventually ends up on a multi-million-dollar annual report? It's not random. It follows a specific, rigorous path. I am Suresh Periyasamy. As a chartered accountant licensed in the US, Canada, and Sri Lanka, I've walked this path thousands of times. In this video, we are going to connect the dots. I will show you the accounting cycle, the daily work of recording transactions, and how that work creates the three financial statements that investors rely on.
First, let's look at the roadmap. We call this the accounting cycle. It is a process that repeats every single month or year. It starts on the left with Step 1, Analyze. We look at a transaction, like a bill or a check, and figure out what happened. Step 2 is Journalizing. We translate that event into debits and credits. Step 3, we post it to the ledger to track account balances. We then check our math with a trial balance, make adjustments in Step 5, and finally, produce the reports. If you skip a step, the final reports will be wrong. It is a chain reaction. Let's make this real. Imagine you start a small business called Apex Consulting. We have 3 transactions here. Number 1, you invest $10,000 of your own cash. In the journal, we debit cash to increase it, and credit capital to show your ownership. Number 2, you buy a work laptop for $2,000. We debit equipment, asset up, and credit cash, asset down. Number 3, you finish a job and bill the client $5,000. We debit accounts receivable because they haven't paid us yet, and credit service revenue. This is the raw data entry phase. We are just capturing history as it happens. Now fast forward to the end of the month. This is Step 5, the one beginners often forget. We have to record silent transactions. Look at that laptop. We bought it for $2,000. Even though we didn't spend any cash today, the laptop is older and used. It has lost value. We must record depreciation. We estimate $50 of wear and tear. So we record an adjustment, debit depreciation expense, and credit accumulated depreciation. If we didn't do this, our assets would look too valuable, and our profit would look too high. This brings us back to reality. Once the cycle is done and the adjustments are made, we push a button and generate the 3 scorecards. Think of these as the medical charts for your business. The income statement, this answers, did we make a profit? The balance sheet, this answers, what is our net worth right now? The cash flow statement, this answers, where did the money go? You cannot judge a business by looking at just one. You need all 3. Let's look at the first one, the income statement. This measures performance. It covers a period of time, like a movie. For Apex Consulting, we take our revenue, $5,000. Then we subtract our expenses, the rent we owe, $1,000, and that $50 depreciation adjustment we just made. The result is net income of $3,950. This tells us that the business is profitable. We earned more than we spent. Next is the balance sheet. Unlike the income statement, this is a snapshot, a photo taken at a specific moment. On the top, we list our assets, the cash we have left, the money the client owes us, receivable, and the laptop net of depreciation. Total assets, $14,950. On the bottom, we list who claims those assets. We have liabilities, the rent we haven't paid yet, and equity. Notice something special here? Equity includes your original $10,000 investment, plus the $3,950 net income we just calculated. Total liabilities plus equity matches total assets exactly. The books are balanced. Finally, the cash flow statement. This is the reality check. We made $3,950 in profit, but do we have $3,950 more cash in the bank? No. Why? Look at the operating section. We subtract the $5,000 accounts receivable because we haven't collected that cash yet. The statement shows that our operations actually consumed cash this month. The only reason we have money in the bank is because of the financing section, your initial $10,000 investment. This report saves businesses from running out of cash while still making a profit. Do you see how they connect? This is the secret to understanding accounting. You must calculate net income first. That net income flows into equity as retained earnings. That equity number is the missing piece that makes the balance sheet balance. They are all part of one ecosystem. If you make a mistake in the journal entry in Step 2, your balance sheet in Step 6 will never balance. Accounting is a story told in numbers. The cycle is how we write the story, and the financial statements are the book we publish. If you are a student, mastering this flow is the key to passing financial accounting. If you have questions, or if you need personalized tutoring for your CPA exams, please feel free to email me at spidvisory.co@gmail.com. Don't forget to check out the Accounting Basics playlist on my channel for more guides. Thanks for watching.